Well, stocks traded to fresh record highs to close out last week, while the dollar rebounded as well, with markets pricing out a January Fed cut after what was a bit of a mixed bag of a December labour market report. But the fresh trading week gets underway with a distinct sell America vibe sweeping across financial markets, with treasuries, the dollar and stocks on Wall Street all softer and precious metals gaining ground once more, with President Trump ramping up his feud with Fed Chair Jerome Powell. Looking ahead, while focus will obviously remain on developments of the Fed, market participants will also digest this week's US inflation and retail sales figures, plus the start of fourth quarter earnings season as well. Plenty for us to discuss on the show, so without further ado, let's crack on with things. So plenty of moving parts in financial markets as the second proper trading week of 2026 gets underway. Joining me to try and make sense of everything that's going on is Ryan Littlestone from Pepperstone Live and Forex Analytics. Ryan, very good afternoon to you. It's the first time I've spoken to you this year, so I can say Happy New Year, even though it does feel a little bit late. And well, the year has started with a bit of a bang for financial markets, hasn't it?
You could say that. We thought it was going to be a nice quiet one coming into the new year, and wallop. Mr. Trump has decided he's going to kick things off by throwing a few grenades around in various geopolitical entities and feds and whatever. So, yeah, a lively one. And Happy New Year to you. Probably about the 8th time I've said Happy New Year to you, but I know you won't get bored of listening to it.
It's all right, I'm counting. You can say it in March if you like. But you're absolutely right. Trump seems to be sort of throwing things around on many fronts, capturing Venezuelan President Maduro, talking about taking over Greenland, buying mortgage-backed securities, trying to cap credit card interest rates. Obviously, this latest issue with the Fed, I mean, I've probably missed 5 or 6 things in there as well. It's been such a busy start to the year. We'll get on to the Trump shenanigans momentarily. But first of all, I want to just dig into Friday's US labour market report. So let's get on with that first of all. So the December jobs report released on Friday. Sadly, I did not win the Forex Analytics sweepstake yet again, not because of any rigging, but because my guess was shocked. Having expected payrolls to rise by 110,000, consensus was at 70,000, incidentally. Headline payrolls in December actually rose by just 50,000, which, when you consider that Fed Chair Powell has said previously that may be overstating jobs growth by as much as 60,000, you're essentially looking at payrolls growth having been flat on the month. As if that wasn't bad enough, all of those 50,000 jobs pretty much came from the healthcare sector, which contributed 39,000 jobs. And of course, healthcare is non-cyclical. And there was also a net downward revision to the tune of 76,000 to the October and November payrolls numbers. So not particularly pretty when you look into the details of the report, despite the headline print. And actually, private payrolls excluding healthcare have now fallen in every month bar one since May, which in my mind is not a sign of a resilient labour market. And in fact, it tells us that if the population wasn't aging, then the labour market actually wouldn't be adding any jobs at all. The household survey was a little bit more optimistic. Unemployment down to 4.4% in December, 4.375% for those who like these figures unrounded. And that was actually down from a downwardly revised 4.5% in November. But again, dig into the details, because the reason unemployment fell was not more people getting jobs, it was the shrinking labour force. So people actually giving up on looking for a job. That said, the Fed are likely to take some degree of solace in the stabilising unemployment rate. Markets now pricing just a 5% chance that the Fed deliver a cut in January, with the next cut not fully discounted until the June meeting. However, the labour market potentially is not as robust as those headline figures would appear, which potentially means that the Fed might be running the risk of falling behind the curve here. Having said that, I'm assuming that monetary policy is made in an orthodox manner, which I think it still will be, but obviously with the Department of Justice sending subpoenas to the Fed ostensibly regarding their building construction work, but in reality, because they haven't lowered rates and done the president's bidding, I guess having a sort of concrete Fed policy outlook at this point is a bit of a mug's game, maybe.
Yeah, on the other hand, they could just follow Trump's tweets and get the jobs data sometime before it's actually released, as he put out a tweet about the annual numbers.
That's farcical, by the way.
Well before the release, but this is the world we're living in. There's different trains of thought. You can dig into the numbers like you do every month, and pull out the negatives or positives, whatever they may be.
Negatives.
Yeah, negatives after negatives. And I think if you look at it overall, take the numbers at face value. We got 50k jobs. The jobs market still isn't falling off a cliff, and that's been the main theme throughout last year and coming into this year. I think if you're going to be looking at a minus 100 to plus 100 range, anything outside of that will really get the market moving. Anything in that sort of range is probably going to be par for the course, because we're still in this low hiring, low firing mode, and you're going to get these swings when you're dealing with double digits. So I think from this point onwards, the market is going to need to see signs of a trend. Yes, we've got a slowing trend, but we've not got something that anyone needs to push any panic buttons over just yet. I think that's the main thing we need to focus on going forward.
Yeah, I think you're right. Kind of continuing the vibe that we saw for most of last year. No hiring or slow hiring, but very, very slow firing as well. Slow hiring, slow firing. There we go. Got there in the end. Well, I was just distracted by the minus 100 to plus 100 market you made me. I mean, that's about as wide as the spread you would have made on the live floor, I imagine, back in the day. Anyway, moving on from that, geopolitical events squarely in focus as the year gets underway.
Yeah, as you said, 2026 kicking off with a bang, and central banks look to be taking a back seat already. So something we spoke about in our last show back in December, how 2026 would look for a lot of economies and central banks. And this first week's trading can always be a bit tricky. Markets players come back, they start repositioning themselves for the weeks and months ahead. You can't really get a good read of what's developing, and the first round of data, all this jobs data and the ISMs, really passed by without much fuss. And as we said, it's been Mr. Trump that sparked the headlines. He piled into Venezuela, threatened to do the same in Colombia, Cuba, Mexico, and a few others he found on the map of South America. He fancies taking over Greenland. He's threatening to pile into Iran now during all these protests against the leaders they're having over there and over the weekend. And now, as we said, he steamed into the Fed over its renovations of all things. And I think the biggest shock from that was the strength with which Powell responded to that. He came out with a statement which even included a video. Now, previously, when we've had these bum fights between Powell and Trump, he's paid it lip service, in FOMCs when he's been questioned at the pressers. But this was a real strong fight back, a real strong pushback, and he's made it absolutely clear which side of the fence he's sitting on and what this all means. But that's, going to play out over the sessions ahead. So there has been plenty in the mix for risk at the start of the week. And as I said, this Fed story might be one of the strangest of them all, considering he's just about to announce his Fed pick to replace Powell. His term ends in May. Now, the initial price moves have shown a theme of what we've coined since Trump came in as US risk off, which has been higher yields and the dollar getting sold. And it's a complete flip around to what we saw even on Friday. But I want to kick this over to you now, mate, because you've already posted about the potential ramifications from this Fed thing, what it means for Fed chair picks and passing people onto the Fed. So I'm going to kick it over to you. You've got some insight into this.
Thank you, mate. Yeah, I did knock up a quick note this morning. I actually wrote it, sat on a very windy railway platform at London Bridge, which was not on my bingo card for this morning, but there we are. Yeah, I think there's a few sort of implications from this. And I think the first is that actually think about the goal. I don't know what the goal is here, because Powell is leaving his post as chair in basically 4 months today. He's going to be gone. He's not going to be in the chair anymore. Trump's going to have his own man. So in terms of the timing, I find that very, very strange indeed. And actually, speaking of his own man, I think Trump has made almost a mistake of shooting himself in the foot here, because you now have a few senators and even Republican senators, Tom Tillis, for example, who sits on the Senate Banking Committee, saying, I'm not going to confirm anyone to the Fed, whether it be a chair or a governor or whoever, until this legal matter is sorted. And that could be a very, very drawn out process indeed. So that is going to complicate the whole decision-making process around actually getting Trump's man to helm the Fed, whether that be Kevin Hassett or Kevin Walsh or Chris Waller or whoever it may be. Then you've got the case of Powell himself. I mean, this is going to be a very drawn-out legal matter, but I would say you probably now need to mark higher quite considerably the odds of Powell remaining as a Fed governor until 2028 if he sees this as a sort of existential threat to the independence of the Fed. And then you look at what else is going on. And of course, next week, Governor Lisa Cook begins oral arguments in the Supreme Court case against her firing. Now, that's on allegations of mortgage fraud as opposed to anything to do with these building renovations, which, of course, she denies. However, this is quite blatantly a political sham to try and force Powell to do the administration's bidding. And I would argue that this actually strengthens the defense for Lisa Cook in that Supreme Court case that's going to start next week. So in many ways, the market reaction is understandable. You've got to attach a higher risk premium to treasuries, a higher risk premium to the dollar now. I'd imagine stocks shrug this off in relatively short order, but I think it's all just a bit counterintuitive and a bit of a head scratcher, to be honest. But I certainly don't think that it's going to end in the way that Trump would want this to end.
No, I don't think so. But even as we learned today, I mean, we were talking about this just before the show and in our chat room earlier. You know, you get the headlines initially and the market reacts and you draw your conclusions. Then as the days progressed, you know, you've seen further details coming out. You know, Bill Pulte is apparently the man behind this push to get this done. Trump's denied all knowledge of it. Hassett's come out saying he doesn't think Trump knew anything about it. But this has come from his administration, so he's responsible for it in one way, shape or form. And maybe Trump's denial is sort of hanging Pulte out to dry a bit. But one question that no one's asked is, what's the point? You know, what is hoped to be achieved from this? I wouldn't call it conviction, but a ruling that the Fed overspent on renovations. So what? I mean, you know, you've only got to come to this country to find out about overspending. Is it really about that, or is it about nailing Powell for something, anything that he can nail Powell for? And even in that point, well, what's the point? As you say, he's gone in May. You know, why do you need to nail him to the cross for anything?
I think it's that. And I think the other unintended consequence of all of this is that actually you've now raised the bar for rate reductions. I mean, we were talking on Friday, the Fed are not going to cut in January on the back of the jobs report, but the Fed are now going to want to be seen not to sort of acquiesce to the administration's desires, which on net has hawkish policy implications, which again goes against what the admin are trying to do. Anyway, I'm sure this is going to rumble on for weeks and weeks and weeks. If I could be short a politician's career, I would probably be limit short Bill Pulte right now, but we'll see how his longevity pans out. In any case, I wanted to have a look at the UK because we get our first major data release of the year here in the UK on Thursday with the November GDP figures. Now, it's very noisy and very volatile, this month-on-month GDP data, but the economy is nonetheless expected to have grown by 0.1% on a month-on-month basis, which is not exactly setting the world alight and will be driven almost entirely by the restart of production at the Jaguar Land Rover plants. But do bear in mind, we haven't actually had any economic expansion since June of last year. So I guess we've kind of got to take what we're given at this moment in time. That GDP data, though, perhaps more importantly, will kind of set the tone for the following week, which is much busier in terms of figures. We get jobs, inflation, retail sales, and flash PMI numbers. And I think we get the latest public borrowing stats in the mix as well. But I think all of that is likely to really just reaffirm what is still a pretty ugly macroeconomic backdrop where, as I just alluded to, we have, well, I've written slow growth. I would say no growth at this point. Well embedded disinflation as the demand side of the economy weakens, and really rapid deterioration in the labour market. Unemployment is already at a 4.5-year high, and it's probably going even higher than it was that 5.3% peak during the pandemic. Now, all of that would suggest, and I don't think I've really spoken to anyone who disagrees with this, that the BOE should just get back to neutral basically yesterday. If you assume neutral to be around the 3% mark, Yet, actually, the December MPC meeting was relatively hawkish. And you even had the Governor, Andrew Bailey, talking about slowing down the easing cycle, which, when they didn't cut between August and December, I mean, you're basically slow enough as it is. Now, the obvious risk here is that the BOE are just so far behind that they can barely see the curve. So I think personally, taking with the assumption that you've got all of these goings on at the Fed, there's very little to justify the pound trading where it is at the moment, as it feels pretty much inevitable that this data is just going to remain soft and the BOE are going to have to pull an almighty U-turn at some point. So the obvious trades are short the pound, long the front end of the gilt curve, and long SONIA futures. But Ryan, can you see any reason why the BOE should be dragging their heels on this?
Yes and no. On the current data, no. On the fact that we know, and we point this out on shows previously, even through the big inflation spike, UK inflation can always, well, I say always, is usually far more sticky than we see in other countries. I'll be very surprised if we get down to sort of Eurozone levels, 2%, under 2%, that sort of thing, unless the economy is really doing, far worse than it is now. So on that front, it's a possibility. If the economy is just going to slouch along as it has been, then I think we might see some inflation pressures. Again, I haven't changed my view, and I'll speak about this in my play of the day. I haven't changed my view on the UK. I'm bearish on the UK. I do, however, see the potential for maybe a little bit of a year-end pickup in the data. We saw that in the last set of PMIs. I think maybe the consumer getting hit by all this tax stuff and everything going on from Reeves might have a bit of a sod it, let's have a blowout at the late part of the year and we'll worry about it in the new year type thing. So I can see maybe the consumer being a bit buoyant into the end of the year. That might paint a bit of a false picture for the pound and for viewers of the UK think, oh, the UK is not doing so bad, because I think once we're over that hump, then we get back to seeing poor data, and then it's the severity of that poor data that will tell us whether the BOE need to speed up or not, and I think that will be the case later on.
Yeah, I think it's looking like February is going to be too early for another cut from the bank. Maybe March if they've got enough evidence by then. But yeah, it feels like they're fighting the last battle, not this battle, if that makes sense. Yeah. Hugh Pill talking about the risks of inflation persistence. And yes, you got your fingers burnt on that after COVID. You were too loose for too long. Every G10 central bank was. I mean, even the BOE made a mess of that because they were the first to hike. But whatever, that's not a problem now. Forget that. Look at the economy as it is now, because if you read the minutes of the December MPC meeting, what Hugh Pill has said, what Catherine Mann has said, it's almost like their comments about a different economy. That's how far away they are from what's actually going on the ground. But the final point I would make is that the August cut and the December cut, they both came via 5-4 votes, and the decision to hold in November came by a 5-4 vote the other way round. So we're talking about the BOE outlook. It's so finely balanced that one or even two policymakers changing their view will have a significant impact on the overall trajectory of policy. If Catherine Mann suddenly becomes the uber dove that she was a few years ago, then bang, you've got 5 votes for a cut at every meeting. So do bear that in mind when we're looking at the UK as well. But anyway, let's go back across the pond and look at the dollar, because I believe for the dollar index, it was the best week since November last week.
If I looked at the dollar index, I might be able to agree with you, but I don't. No, I'm not. But yes, the dollar has been off to a bit of a bright start this year. Market's been getting back into the groove, and that was really the standout theme, particularly last week. And coming into the year end, there's been some underlying dollar strength. We're not talking anything massive, but it's just been a bit of the theme that's been playing out. We saw, as I say, a bit of this in the latter part of December. And despite the odd wobble in place last week, it's remained in place. Now, there is a bit of selectiveness to some of this strength. For example, the Aussie dollar seems to be holding up much better against the US dollar. But if we look at something like euro dollar, we are continuing to unwind the late November and year-end rally. As I said, with a few exceptions, we have been consolidating pretty much since the summer. So we know that the current boundaries are for this pair really 115 to 119. Now, if this phase of dollar strength is going to continue, we may be heading for a test of that 115 level. We've got the ECB thinking that it's got inflation in a good place and thus interest rates in a good place. So moves in this pair are perhaps going to have more of a dollar influence once again this year, like it did a lot last year, unless something materially changes in the Eurozone. Now, there's plenty of levels to trade in the short term, but don't lose sight of this wider picture, because if we do break either side of this big range, it might indicate we're going to get a bit of a trend change. And those are the ones, if we get those breaks, they're the ones that are going to bring the big news, or big moves. So keep an eye on the intraday levels, but don't lose sight of these wider ranges, 115, 119, because I think, as I say, if we start breaking through those, we're going to see a significant move either way.
Yeah, very much so. I mean, the last time spot was below 115 was what, last summer, July, August time. I can't quite see on the chart. I've got a camera in the way. But absolutely, I think we do need to focus on that. I wrote in my sort of 2026 year ahead pieces that I was actually quite bullish on the dollar coming into this year. And a lot of that was predicated on the idea of essentially buying growth and a return to US outperformance. You look at the economic tailwinds that the US has this year, the majority of that tariff uncertainty has now gone and lifted, and the pass through into prices is probably over.
Until Wednesday.
Well, I was just about to come on to that. And you also look at the fiscal side of things and you say, well, actually, the One Big Beautiful Bill Act is going to be a big tailwind from a fiscal perspective, certainly those tax rebates that are going to come in the second half of the year. Having said that, now that Trump's starting to attack the Fed again, I must admit I'm starting to get a little bit nervous, because I think no matter what sort of economic growth you're looking at in the States, whether it be 3, 4, 5% quarter on quarter annualized, the market's going to be more worried about policy independence, or the perception of policy independence, than it is, where GDP is or where interest rates are. So I wouldn't be surprised if we did see potentially a little bit of an unwinding of some of this recent dollar strength. And then the question is does the air clear enough between Powell and Trump that the market can refocus back on what is actually an underlying bull case that I still quite like for the dollar? Or is all of the air just still taken up by these worries about policy independence? And if it is, the last thing you want to be is long of the dollar, I think.
Yeah, no, I absolutely agree with that. I mean, you say that, talk about dollar strength, he did nothing but weaken against this pair pretty much all year. And, you see on the chart there, it's held these gains. We couldn't even get close to the 38.2 of the year's move, whereas a lot of other pairs, dollar CAD, Aussie, cable, they all managed to pretty much break their trends. But this one's held on. So, I think it's a bit of a coin toss from this point forward. But as I say, you've got two clear levels to decipher that anyway.
Yeah, and there's no need to rush. Just wait for the market to tell you which level it wants to break. And on that note, let's move on to our plays of the day. In speaking of views that I'm starting to get slightly nervous about, I guess I'll throw this one on the pile as well. I am still bullish risk, before anyone misquotes me on that one. But let's have a look at the S&P 500. It was a pretty decent first proper trading week of the year last week, with the S&P trading new record highs, futures north of 7,000 for the first time ever. And momentum begets more momentum. Record highs tend to beget more record highs. Now, of course, we're seeing a little bit of trimming of exposures today. Of course, we're seeing stocks take a bit of a lurch lower as the market digests and discounts these developments with the Department of Justice and the Fed. However, as I alluded to earlier on, I think it's treasuries and the dollar that need to price a greater degree of risk around that than it is equities necessarily. And I would imagine that the market will relatively quickly refocus on that fundamental bull case, which is still basically what it was in 2025. Very strong economic growth, very solid earnings growth, and a looser monetary and fiscal backdrops as we move through the next year or so. Earnings season, of course, starts this week with the banks, and we would look for solid numbers there in order to reinforce that bull case. But as long as the banks meet or indeed beat expectations, then I think the bull market is likely to roll on, and that the path of least resistance should still lead to the upside for the time being, once the market gets its head around what's going on with the Fed and can refocus on the fundamental underlying bull case. Ryan, we're going back to the UK.
Yep, back to the UK and an old favourite of mine, Euro Sterling. And this has been a theme that I've been running. We've been running on the show here since last summer because I remain bearish on the UK economy and have been playing on the long side of this pair since then, pretty much. My view hasn't changed, and it won't change until the data changes significantly in the UK. We've hit a bit of a traffic zone around the 86, 45, 70 area. And that was after the pair reversed from the post-UK budget high. That move smelt a bit like some year-end squaring up and a bit of buy rumour, sell fact over the budget. But we also did see some positive data points out the UK, such as the PMIs. Now, despite my bearish view continuing, as I said, I do see the prospect or the risk of some further, maybe call it patchy positivity from UK data, particularly on the consumer side, as I think many people had a Christmas splash out. I think if we do see that, then we could see the pound rallying a bit further, and then maybe that washes out and we push back to being bearish again. Now, there's merits in looking at longs while this zone holds as support, so down into that 86.45 area. And if not, look down towards the 86, 85, 90 areas. That's been pretty solid too. Things might look a bit more iffy, though, if we're heading down to the big 85 level, as that maybe means something has changed in the data. But even then, I wouldn't rule that out, seeing the move down there in the early part of the year, if we see better data over the next couple of months.
Very good. One last thing. We've spoken a lot about the UK, and I think I mentioned this last year. We're talking about how dire the UK outlook is, labour market off a cliff, et cetera, et cetera, et cetera. Give me a probability we have a recession this year, because no one's talking about it.
Well, there's a technical recession. I think we're definitely going to see. Whether it's a deep-rooted recession.
Oh, yeah. Let me clarify. I'm just talking 2 consecutive quarterly contractions. I don't care how deep.
Oh yeah, I think we see that, and I think if I'm wrong and we don't see positivity coming into the end of the year, we could start seeing it from Thursday if we get a negative number on GDP. The bar's pretty low when you're looking for 0.1% gain.
Well, yeah, exactly. I'm glad you said that, because I was just going to say I would not be at all surprised if it was Q4 25 and Q1 26. And that's it, done for the year. Anyway, that brings us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forexo Live and Forex Analytics for joining me. Thank you to our producer, Kyriakos, as well, for bringing things together as brilliantly as always. Hopefully you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know your thoughts on everything we've discussed, and if there's anything you want us to look at next week, and that is when we'll be back with another episode. In the meantime, have a very good week ahead, and we'll see you then. Thanks for watching. Goodbye for now.